In this video, we will explore about option terminology to help you navigate the world of market terms, mechanics, and contract specifications. We will use real-world examples from the Nifty 50 and Sensex to make these concepts clear and easy to understand. To begin, let us look at how an option is quoted in the market. On May 10th, we see two different types of quotes for the Nifty 50 index. The first is a call option and the second is a put option, both expiring on May 25th. You will notice a strike price of 18,400. For the call option, the closing price or premium is 124.50, while the put option is 177.60. We also see the open interest, which stands at 14,97,650 contracts for the call and 4,97,950 for the put. All these numbers are based on an underlying market value of 18,315.10. Now that we have seen a quote, let us break down the types of assets and the people involved. Options can be based on an index like the Nifty or Sensex, or on individual stocks like ONGC or NTPC. In these trades, you have two main participants. The buyer is the person who owns the right to trade but is not forced to do so. To get this right, they pay an option premium. On the other side is the writer or seller who receives that premium. Because they took the money, they now have an obligation to buy or sell if the buyer decides to exercise their right. Options also come in different styles. An American option allows the buyer to use their right at any time before the contract ends. However, a European option can only be used on the actual expiry date. It is important to know that in India, all index and stock options follow the European style. We also use specific terms for pricing. The premium is the actual price the buyer pays the seller. The spot price is where the index or stock is currently trading in the market, such as 18,315.10. Finally, the strike price is the specific price, like 18,400, where the buyer and seller have agreed the trade can happen. There are three more important terms we should cover. Open interest tells us the total number of option contracts that are currently active or outstanding in the market. When a buyer decides to use their right at the end of the contract, we call this the exercise of options. Since Indian options are European style, this only happens at maturity based on the final closing price. When a buyer exercises, the exchange randomly assigns that trade to a seller, which is known as the assignment of options. When you start a trade, you are opening a position. An opening transaction simply creates a new spot for you in the market. If you want to own an option to have a right, you make an opening purchase, which means you are going long. If your plan is to sell an option and collect the premium, you make an opening sale, which puts you in a short position. To get out of a trade before it expires, you must close your position, which is often called squaring off. If you started with a short position, you perform a closing purchase, also known as covering, to exit. If you were long, you perform a closing sale. A very important thing to remember is that you cannot close a long call by simply buying a put. To properly close a trade, you must buy or sell an option with the exact same strike price and expiry date. The exchange sets almost all the rules for these contracts, except for the premium price. One major rule is the contract size or lot size. This is the number of units bundled into one single contract. For example, if the Nifty has a lot size of 50, we calculate the total cost by taking the premium and multiplying it by 50. For a call premium of 124.50, the total contract value would be 6,225 rupees. For a put premium of 177.60, The value would be 8,880 rupees. Trading happens in cycles. For stock options on the National Stock Exchange, there is a 3-month cycle including the near month, the next month and the far month. Index options for the Nifty or Sensex have even more variety. They are available in weekly cycles, monthly cycles and even quarterly or long-term half-yearly cycles. This gives you many different time frames to choose from for your trades. Every contract has an expiration date, which is the very last day it can be traded. For Nifty and Bank Nifty monthly contracts, this is usually the last Tuesday of the month. If that Tuesday is a holiday, it happens on the trading day just before it. According to a SEBI circular effective from November 20th, 2024, exchanges can now only offer weekly expiry for one of their benchmark indices. For example, the BSE can offer weekly contracts on either the Sensex 30 or the BankX, but not both at the same time. Next, we have the tick size, which is the smallest amount a price is allowed to move. For index contracts, the tick size is 0.05 rupees or 5 paisa. For individual stocks, it can vary. Stocks priced below 250 rupees might have a tick size of 0.01 paisa, while those above 250 use 0.05 paisa. A smaller tick size is great for managing risk because it allows for very precise price adjustments. Unlike some other financial products, options do not have a daily settlement. Because they are European style, they are only settled on the expiration date. The final settlement price is the closing price of the index or stock in the cash market on that final day. You can trade these equity options during normal market hours, which are from 9:15 a.m. to 3:30 p.m. Monday through Friday, excluding public holidays. Finally, let us look specifically at the BSE Sensex option contracts. These have a contract size of 20 and a tick size of 0.05 rupees. They follow a cycle that includes 7 weekly, 3 monthly, 3 quarterly and 8 semi-annual contracts. While the weekly contracts expire on Thursdays, the monthly and longer contracts expire on the last Thursday of the month. Just like the others, these are European style and settled in cash based on the closing price of the Sensex index.